So economic growth and GDP, GNI. So when we talk about economic growth, we're talking about the output of a country. That's what economic growth is. And how do you measure the output of a country? You measure the output of a country using the gross domestic product, the GDP. So your GDP will give you your national income. I think that's clear. So yeah, measures of national income. The national income is measured through the GDP, like I told you. So what is the GDP? It is the total market value of all goods and services produced in a given economy. So this country, the total value of what is being produced in this country in terms of goods and services gives us our GDP, which is the measurement of our national income. So GDP is measured at market price, which means it is measured by including the value, including the indirect tax. So that means whenever we are measuring the GDP, we have to measure it using the market price, which includes taxes on expenditure. Do you understand? So when you are measuring your GDP, it has to be through the market price. And your market price includes your indirect taxes on expenditure. Is it clear? So there are other measures of national income. There are other ways we can measure the national income, not only through GDP. So one, we have the gross value added, which is the GVA at the basic price. So here, it is calculated as GDP minus indirect taxes plus subsidies. So for your GVA, that's gross value added, it is GDP minus indirect taxes plus subsidies. I think that's clear. So we have the GNP, the gross national product, which is the market value of goods and services produced over a period of time through the labor or property supplied by citizens of a country, both domestically and overseas. So what we're talking about here is, for your GNP, it is the GDP plus earnings from overseas. So what the value of what has been produced by the citizens of this country here and outside is our gross national product. Do you get gross GNP now? Yeah. So that's why it is GDP is equal, or GNP is GDP plus earnings overseas. So what is being produced here, sent abroad or sold here, gives us our GNP. So another way to measure our national income is using the GNP. And GNP is what? GDP plus earnings from abroad or overseas. GVA is GDP plus indirect taxes. GDP minus indirect taxes plus your subsidies. I think that's clear. Yeah. So another measurement of our national income is through the gross national income, GNI. So for the GNI, it is the value of the goods and services produced by a country over a period of time. So for GNI, it is GDP plus net overseas from interest abroad plus your dividends. So when you talk about interest, that means we're talking about interest and dividends, which means the income from our factors of production. You know the factors of production, right? Capital, enterprise, capital, enterprise, labor, land. So these are all investments. So whatever we make from these things, from these factors of production, are what we call factor income. Do you get what factors income is now? Yeah. So the income we make, that means we're talking about interest, we're talking about profit, we're talking about rent, income on rent, we're talking about wages. So all these factors income are together with your GDP, gives us our gross national income. You understand GNI now? Yeah. So GNI is what? GDP plus net overseas interest payments and dividends. Dividends are investment, like you as the Libyan citizen being a shareholder in some companies abroad. So the dividends that comes in, they are income. They come to the country. So that's what we call gross national income, which is what? GDP plus net overseas interest payments and dividends. Both of them are what we call factors income. Is it clear? Then we have our net national income, NNI. So here, this is the value of a country's national income after depreciation. So the value of your national income minus depreciation gives you your NNI. So NNI is GDP minus depreciation, or national income minus depreciation. Is it clear? So what you need to know is your national income. Your national income is equal to your gross domestic product. Your GVA, which is your gross value added, which is GDP minus indirect taxes plus subsidies. Then we have our GNP, which is GDP plus earnings from our overseas or abroad. Then we have our GNI, which is GDP plus net interest from dividends. That means our GDP plus all incomes made from the factors of production. Is it clear? And NNI is GDP minus depreciation. Any question about measurement? So we'll go to real or volume versus nominal or value. So when we talk about the real national income, we're talking about the volume of the national income. And when you talk about the nominal national income, we're talking about the value of the national income. So for the real or volume of national income, this implies measuring the national income, putting into consideration the inflation rate. So when you are putting into consideration the rate of inflation, when you are measuring the basket price of goods and services in a country, then it is a real GDP that you're going to get. And for the nominal GDP, it means you don't put into consideration the inflation rate. You didn't put it into consideration. What you only put into consideration is indirect taxes. I think you understand the difference between both. So, with real or volume of national income, we get what we call our volume of national income. And what is volume of national income? It is the basket of goods and services that can be bought within a given amount of money. So, what you can buy with certain amount of money that you have is what we call the volume of your national income. Then the value is the measure of the basket of goods and services at each given price level. What you can buy, the quantities you can buy with the amount of money you have is the volume of your national income, volume of national income. But the value of national income is the measurement of the food basket of goods and services that can be bought at different given price levels. At this price level, this is what can be bought. At this price level, this is what can be bought. That is what we mean by the value of national income. Is it clear?
Yes.
With our national income measurement. So now we go to total and per capita. It's another way of measuring the national income. But here, if as a country, whenever we need to measure the economic welfare of citizens, so it is better we use the income of that economy. So that means we're talking about the living standards of the people in the economy. That's their economic welfare. So to measure the living standards, you use the GDP per capita or the GDP per head. And the formula is, like I told you earlier, GDP divided by the total number of the population. So that's what we're talking about, total and per capita. I think that is clear, right? Now we go to transfer payments. So these are income for which there are no corresponding output. For the transfer payments, these are payments you receive without working for. You did not produce anything, you did not render any service, but government gives you this money. So these are incomes that we receive without any output in return. We call it transfer payment. Example is unemployment benefits, pensions. So you don't produce anything, but because you're not working, because you're not engaged, the government of this country is helping you out. So that's what we call transfer payment. So when you are measuring the national income of a country, you have to take it away from your public expenditure. So it must not be added to your national income. So that means if you are measuring the national income now, you know you have to take away your public expenditure. But before you take away the public expenditure, from the public expenditure, you have to minus the amount of money spent as transfer payments. So what is left is what you take away from your national income. So that's why in your national income you have the GDP plus GDP minus public expenditure. But before you talk about the public expenditure, it would be public expenditure minus transfer payments. Is it clear?
Yes.
Because transfer payment, nothing is worked for. Nobody has done anything. No output. It's just the money you received as a benefit. Is it clear?
Yes.
Then we go to why is national income measured. So we're talking about the importance or the uses of national income. Number one, it helps to increase our understanding of how the economy works. So now you know how the economy is working. So you know that, when we talk about GDP, we mean the national income of the country. When we talk about GVA, we know it is GDP plus indirect plus subsidies minus indirect taxes. We know that when we talk about NNI, it is the GDP minus depreciation. Then when we talk about GNP, we know it is GDP plus factors income. Do you understand? So now we know how the economy is working. So we are able to know them because we are measuring what? Our national income. 2, government firms and economists use the figures to forecast changes in the economy. So with this analysis, with these statistics, government, economic agents, firms, they will be able to predict what could happen in the future. Is it clear?
Yeah.
3, they are used to make comparisons over time between countries. So with our national income, we can compare Libya economy with Turkish economy. Do you understand? We can say, oh, how is the living standards in Turkey compared to that of Libya? Then we measure the GDP of Libya divided by its population, the GDP of Turkey divided by its population. Then we are comparing. The last one, they are used to make judgments about economic welfare, like the GDP per capita. We just talked about it. So you will be able to know which country is poor, which country is rich, which country is richer, which country is poorer. This is why we measure the national income. So in the exams, they might ask you, what are the uses of national income or the importance of national income measurements? So these are what you say. Is it clear?
Yes.
Now, the national income, most of the time, they are not accurate. Why? So reasons why the national income are not accurate. Number 1, statistical inaccuracies. Here, it says, since national income statistics are calculated from millions of different returns to the government, it is inevitably that mistakes will be made and some data may not be completed. You know, through government ministries and parastatals, we collate data, statistic. Are you with me? Please, you have to look at me. We collate data statistics from government parastatals. So in the course of collating these data, there may be mistakes in the figures. Or some government agents, because they are lazy, they did not finish their statistics or their statistical assignments. So because of their own laziness and probably errors, we won't be able to get correct figure for the national income measurement. So statistical inaccuracies might make our national income measurement not accurate. Number 2, the hidden economy. When you talk about hidden economy, here I wrote, taxes such as goods and services taxes and government regulations such as health and safety laws impose a burden on workers and businesses. What are we saying here? Firms have to pay taxes. Workers have to pay taxes. These taxes are a burden to taxpayers. As a result of this, they might want to evade tax. They might not want to pay tax. So, because they don't want to pay taxes, they will start working through the black market, through the black economy, hidden economy. So they wouldn't want to work, they wouldn't want to let you know their output. Because it is only when you know their output, you know their function, their operation, government will want them to pay tax. But yet they will be keeping everything. They won't want to work in the open. They will be working behind. Yeah. So a lot of businesses are available that they don't even pay taxes. These are what we call hidden economy. Do you understand what hidden economy is here now? Yes. People working to evade tax. Taking the burden of tax away from them. So this will not make us to have an accurate figure of our national income, isn't it? Yes. We are talking about reasons why the national income measurements are not accurate. Are you with me? The first one is statistical inaccuracies, yes. Which, the government institutions are the ones that come up with these statistics. Because they are government parastatals, government workers, they might be too lazy to complete their operation or their function. As a result of this, we don't have accurate figures. Some figures might be missing. 2, hidden economy. People can work to evade tax. 3, unproduced services. There are a lot of production, especially domestic production. Some people are producing for their own self. So because they are producing for themselves, we are not recording it in our national income, which is supposed to be measured. Because due to that, you are not paying certain amount of money, or you are not getting certain amount of money from government because you are maintaining yourself. You are subsistence. So there's subsistence farming. People are working for themselves. People are making ends meet themselves. They are producing for their own consumption. All these things should be added to the national income, but they are not always added. Women will be at home working, doing domestic jobs, but nobody records these transactions or these operations. So because we don't record all these things, it will make our national income not accurate. Do you get it?
Yes.
For example, look at the GDP per capita. You are measuring the national income of a country divided by the population of the country. But the population of the country, a lot of population of the country are making money too, which are not part of the records. So this will make the GDP per capita fall. Then you will be thinking that the country economy is poor, not knowing that a lot of people in the economy are not recording their national income, are not recording their own income or paying taxes.
Mm-hmm.
Is it clear?
Yes.
The public sector. Why are we talking about the public sector here? In the public sector, they don't buy or sell output. So it is difficult for us to measure their national income. Public goods are goods that are basically for free. So how do they make revenue? So most of the time, they spend more than what they receive. So it is difficult for us to weigh the accuracy. So public sector is difficult to put them into the national income because most of the time, what they produce are for free. Is it clear?
But do they not make more than what they spend?
Yeah, they make. But how is it easy for us to calculate? It is difficult. Do you get the point here?
Yes.
Because most of the time, they don't buy or sell output. They could get raw materials even for free because it's from the government. The government owns the land. And basically, they can produce for free too. So all this production that they do for free must count. Because if government has given certain amount of products for free, it means individuals would have spent less. So it will make the national income balance because some figures will be missing due to the fact that some people have received certain benefits without working for them. So all these things will not make our national income measurement accurate.